You are listening to Mining Stock Education.
Thanks for tuning in to another episode of Junior Mining Insights, my monthly chat with my co-host and friend, Brian Leni of Junior Stock Review. Brian, let's get right into it. And we had some good questions come in from listeners after our last episode. And one listener writes, I identify myself with the way you guys invest. I just disagree with not learning from your successes, especially how much success is success enough, and evaluating later the whys and hows that led you to take profits too soon, and if that can be further refined. And I think this is a fair comment because in previous episodes, you and I have been talking about how in making statements such as you don't learn much from your successes because it basically just confirms your biases. And when you fail, you want to learn from your fails. And inherent in kind of our disposition when we talk about that is when we fail, it's easier to blame somebody else. But when we succeed, the default position, if we're not careful, might be to pin it all on our back and take credit for it. So we're kind of reacting against that, aren't we?
Absolutely. And I think it's hard to preface everything that you say. I think, when we talk, it's also kind of fluid and so we're not giving enough attention maybe to the other side of things. The success definitely can be learned from. And I think what it reinforces is what you're good at. And I think playing to your strengths in terms of learning about yourself is super important, especially when it comes to investing, speculating, in junior resource companies. I think the contrast, though, is undoubtedly the biggest learning experiences that you're going to have are from your losses and what sort of led to those losses, how you can improve, what needs to change in your process. And so I think, that's what the main message is that, you really have to look at your failures and learn from them and adjust. That doesn't mean you can't learn from your successes too, but there is that matter of, the bull market. You can confuse a bull market with brains sometimes, and this becomes the tripping point. And I think over enough time as an investor or speculator in the sector, you definitely come to that conclusion that, it's more on the failure side that you need to pay more attention to, and the successes are great. But you really need to look and protect your downside.
So when you think back to your first bull market when you were still working as an engineer and you made some money at that time, what did you learn from your successes? Because you would look back now and say, oh man, I didn't know, half of or a fraction of what I know now. But can you also look back and say, what did I learn from the money that I did make?
Well, I'll put it to you this way, because one thing that stands out is so crisp to me. The thing that I did in that original part is I sold my house and I bought what I thought were going to be the best performing junior companies in 2013, 2014, and somewhat in 2015. And I basically held through that period. I saw the portfolio drop, minus 35, minus 36%. And then of course I had this unbelievable 2016 where the portfolio goes up. I leave my job, become an investor full time. What I thought I learned at that point was, and even looking back, there's holes in it. I thought, what? I buy these companies, I sit on them, and eventually these things are going to come. If I've made the right choice, eventually these share prices are going to lead me in the right direction. And I'm going to have that sort of windfall event. And over the course of the next, 2017, 2018, and even into 2019, I saw that was basically wrong. I saw where the holes were, in your conversation with David Lotan a couple weeks ago, talking about cycles. And when you see money leaving the sector and the fact that if you're going to make money on share price appreciation, you need money to be flowing in behind you to sort of, the greater fool theory of buying share price and then thinking they're going to sell it at a higher price. So with the flow of funds being so important that you basically, you can make money by buying and holding, but you have to be super right about the company and you have to have the patience to wait. And I think for a lot of these junior companies, if you don't have this in mind, you can run into problems with dilution. You can run into a whole host of problems with the other risks for a junior mining company. But I think what I learned was that I have to be taking profits along the way, and I have to find a set of catalysts that are sort of impactful to the market outside of the market cycle being with you, which is hard to do. And I'm not even necessarily sure that you can absolutely do it without other things kind of coming into alignment. But, in 2019, I sort of it was through mentorship that I can remember being in Singapore with a friend and a mentor, and him talking about the importance of selling. And it really came home to me. It's like, you know what? I'm doing this wrong. The reason why I haven't had the greatest 2017 and 2018 wasn't because I didn't necessarily pick right, but because I saw these share prices going up, and I just thought, I'm going to hold and wait for this big event, whatever that may be. And in reality, I need to be taking pieces from those share price appreciation and cycling it back into new ideas or having it sit in cash. And so this whole process is something that, again, I thought I learned something smart by that success. And I ended up learning a bigger lesson in terms of the importance of selling and how I need to incorporate that into my process. And again, the longer you stay in this, the more that becomes apparent.
So this first question, the second part, was about taking profits too soon. Do you think you can take profits too soon? Is there such thing as taking profits too soon? Because, and I'll say this too. I've had listeners on the show that say when you choose, let's say 10 to 12 junior mining stocks, when you have a winner emerge, you have to let it run. Don't take profits too quick because it's going to cover the losses you might experience in 3 to 6 of your other junior mining stocks. So if you don't let it run, your portfolio is not going to do what you would want it to do.
The answer is yes. What that means is that it's yes to all of those. First, I don't think you can take profits too early. I think with the volatility, with all the things that can happen where you can lose your money in this sector, that taking profits along the way that suit you personally, I don't think you can ever fault yourself or anyone for doing that. And anybody who does, just hasn't been in this game long enough. Second, yes, you can sell a winner too early. And I think what that goes back to is not understanding fully what you're actually invested in and what that upside potential will be. If you don't understand where that share price should go and what the speculative touch or upswing with that good news is, then yes, you can sell it too early. And yes, you can impact the rest of your portfolio because typically you are going to have a few losers and you need those winners to pay for your losers. But again, this is probably just an undereducation problem. And, I think over time and effort, those things can be overcome where you better understand exactly what you're dealing with. And then hopefully, you get a hold of one of these bull cycles and that'll make even your mistakes look probably decent. And so then it's less of a problem if you're more prone to selling things early. But in essence, I would not blame anybody for taking profits in this business. There's too many other ways you can lose money. And if you're coming up with new ideas that are based off solid fundamentals, price to value ratio, good people, and you're funneling those profits into new ideas, then I don't see any problem with it whatsoever.
Brian, I'm seeing a lot of new people to junior mining in a lot of the comments on the YouTube videos. People are very excited because we're in a bull market. And when I see some of the comments, I can tell that people are not even fully understanding some of the companies that they're buying, because I met with some of the companies when they put the ticker symbol in. I wouldn't buy it, but as you said in our last chat, they're probably going to make money. Maybe even for years, if the gold bull market keeps running, if gold gets to 10,000, like some people say, in 2-3 years, they're going to continue to make money. And in those situations, if you're not well-to-do and don't have all your needs met, the tendency might be to throw more money at one of these little junior miners than you can afford. And if things turn over and the anxiety goes up, you have to watch yourself, because in 2020 and 2021, when the precious metals started to run, I had one gentleman, a listener of the show, I don't know if he still listens, but he emailed me, Brian, and he was closer to retirement. And he said, Bill, I bought all these junior mining stocks because I don't have enough in my retirement. And I wrote him back and I was like, I don't know if that's the best thing you want to do. You have to understand all the dynamics, because you're mentioning like the flow of funds. That's external to any individual junior. And then you have to do your own due diligence and analyze that junior internally. And then the third component is you need to analyze yourself and your own psyche and your own knowledge or lack thereof and your own financial situation. So the takeaway point is, don't put more money, even in a bull market, Don't go on margin in junior mining stocks is my general recommendation. Most people cannot do that. There's enough inherent margin in these junior mining stocks, and only put what you can afford to lose that wouldn't damage your relationship with your spouse or somebody close to you and wouldn't harm your lifestyle.
Absolutely. That's extremely wise. I still think that most people have to learn by mistake. And, I think, that it shows how wise Rick's quote is about, confusing a bull market with brains, because it's not until you experience that, I think, do you actually feel the weight of it. And unfortunately, I think, Billy, you say those things, and that's exactly the mindset to have. But I still think there's going to be people that don't listen, that think, oh, you know what? I know better. I know how this is going to work out. And for some people, for a handful of people, it might work out that, things work out. But the vast majority of people are going to lose money, and it'll either keep them right out of the space altogether, or it'll be a learning process, and it'll be something that they see, oh, you know what? I can't overextend myself in these bull markets. Even though I make the right pick, I can still lose money. Like if you buy an exploration stock or an exploration company, you have to be in full realization that share price could move in anticipation of those drill results. But the vast majority of the time, it's going to come up empty. And you are, if you're don't have your wits about you, or can sell into some volume, you're most likely going to lose money. And that is probably the reasonable expectation. So like, there's just so much to learn in terms of the mentality you need to have. And then the other aspect is, if you can't grasp, the wisdom of what you just said, then you're going to have to learn through experience. And it's tough to do, but it seems to be so necessary for each and every one of us in some shape or form.
In my conversation with Dave Lotan, which you referenced over this past month, another thing Dave said that I liked and have thought about more since the conversation was when I asked about rumors or gossip about particular mining entrepreneurs, to where you've been told they're addicted to drugs or they've engaged in this immoral activity. And Dave's response was, you should view that with a high level of skepticism, because basically people break down other people in order to build themselves up, in order to try to get your capital or your influence. Any thoughts on this one?
He's absolutely right. I think you should probably be skeptical of anything you hear generally in the investing or speculating world, no matter basically who it's from. You want to you definitely want to look who it's coming from, but you want to do your own due diligence, whatever that looks like, in terms of how you can determine whether what they're saying is legitimate or not. And that doesn't even have to do with rumors or something salacious. It can have to do with, you should look at this company, or you should buy this company or sell this company. You look at motivation and what that might be. I've experienced it myself, where I've seen CEOs or people close to deals badmouth other deals because they want the flow of funds to their share prices. And I think Dave is exactly right that it matters so much in the junior sector, especially when the bull market isn't here, to grab attention and keep attention, that I would almost expect it from a lot of the companies. But yeah, like it's look at who it's coming from, and do your own due diligence as much as you can. And of course, again, this comes with any decision you make. Beware that you might be wrong. And so you might either miss out on something, or maybe you do gain from that knowledge, but it's always going to be your choice, and depending on how you want to view things and move forward.
Brian, with Anon accounts, this is something you and I have talked about a lot. Your face and your name is on the screen right now for those watching. Same with mine. When I started this show, I honestly was thinking, man, I don't even want to have my name out there. But I was like, no, I got to put my name out there. And then when I started to have sponsors, my sponsors were like, we'd rather do a video, not just an audio only. So then now my name and my face is out there. So I understand why people wouldn't want to put their name and their face out on the internet. However, when you're talking about stocks and you put out a ton of bullish posts about why a stock should go up, and you likely own that stock, then the question becomes, is this ethical, and how should this be handled? So over the last couple months, there was a Twitter war that, just because everybody was posting it, I observed, and one of the monikers apparently was referenced as somebody who was a director and a consultant to two companies that he was posting about. So I had no idea. But that just got me to think more about the whole idea of like, if you're a director and you're making public posts about a company, how can you do that under not your name? And how can you not disclose that you're literally an insider in a company that you're talking about? And this is prevalent on the chat boards too. I know, because some of the companies have reached out to me because of my show, and they tell me, we have people in Reddit, we have people in all the chat rooms, and we run programs for companies talking up the stocks, like we create our own boiler rooms within these different platforms. Another situation where a high net worth person gets a following, and they basically can create liquidity out of stupidity, to where if they have enough money, they can get a junior mining CEO to do $1 million financing with them. And then if it's a life financing, it's free trading right away. And you just talk up the stock and the stock goes up. So, when I think about all these things, here's the takeaway. The takeaway is, anytime you hear somebody talking about a stock, why they like it, why they bought it, why it's a sponsor, myself included, ask yourself, if I knew Bill Powers was the one selling me the stock that he's talking about, would I buy it? Now, if you take that approach, that puts the responsibility of you, which means you have to understand why you're buying the stock. And if it doesn't turn out well, you're going to look at yourself and say, what did I get wrong here? Not somebody else. And that's how you grow. Any thoughts, Brian?
I think you're absolutely right. I think that should be the general consensus, is that it comes down to you. And that's ultimately where the success and failure lie. Skepticism, just like what rumors and stuff that you hear, you have to be hyper skeptical when it's an anonymous account. And that's like on Twitter and those sort of social media things. If you look at, my profile, who I follow, I don't think I follow any anonymous accounts. And if I do, I know who the person is, because I certainly wouldn't listen at all if it's coming from an anonymous account, because you don't know who these people are. And I think if you're out there and you're willing to give stock picks or talk something up, why wouldn't you put your name out there? Like I get why you wouldn't, but the other side to it is, why wouldn't you want to actually yourself take the adoration that comes with being right, and put your name beside it. And so to me, it just speaks, untrustworthy. And I would hope that more people become more skeptical of these anonymous accounts and who they might be, especially in the junior resource sector, where this sort of ethical behavior or unethical behavior has become so synonymous, across things. And like I said, both of us have become knowledgeable about these, like you said, boiler room sort of social media circuits that are going on within these different subthreads, and people just have to be hyper aware that they might be being sold down the river by somebody that's being paid by the company or is directly associated with it and is giving you a very biased look at things. But in the end, it does come down to you. And so you can listen or follow whoever you want. But if you make the decision to buy, hopefully you're investigating the company yourself and coming to the conclusion that yes, this is a buy and this is the differential I see in profit. And then you actually take the profit, and not sit there and wait for this thing to go higher, because, like most things, we have more bag holders that follow the roller coaster up and then unfortunately fall it all the way back down and end up selling for what they bought for, or even worse, selling for less, because they missed it. And it's the unfortunate part about this business. I wanted to ask you, Bill, the conversation with Dave, he's always somebody that I look to listen to for a whole host of reasons. One of the things you guys talked about was the flow of money, where we are in the cycle. So my question to you is, where do you think we are in the cycle? What's your takeaway from that conversation?
So I would be, what Rick has said, over the next decade, the dollar goes down 75%. It's probably going to be, the prettiest mare in the slaughterhouse, to quote Doug Casey. And during the course of that, gold's going at least, 3 times higher. So that would be my general perspective when it comes to the gold markets. So I think there's a lot of runway, but I could see pullbacks, obviously, even 40% pullbacks along the way. So I still think there's opportunity, because I sometimes, even when I was just sitting on my couch the other day and just thinking about some opportunities I didn't take advantage of yet in the gold space, to where I saw them, but I wasn't able to take advantage of them, then I was like, I'm not going to get FOMO, because there's going to be another opportunity. So when I see a good opportunity, I'll jump on the next opportunity, but I'm not going to be jealous of somebody that I saw take advantage of a good opportunity and they're already up 4x on the way to 40x potentially if gold goes to 10,000. So I guess I'm monitoring myself in relationship to my expectations, that there's more opportunities and gold has a long way to run.
What about talking about gold expectations, the price expectations? Do you build that into your expectation for profit? Is that something that you say, hey, look, the gold price, I think, is going to go to $10,000, and therefore, well, you may sell along the way, but you're not going to eliminate your position until it hits that? Or is it something that's iterative along the way that you're going to decide how you're going to proceed?
It's iterative along the way. And something I heard Eric Sprott say a long time ago is, and you quote Rick Rule often, where Rick says, every day you don't sell a stock, you buy it again, right? So I look at the opportunities I'm presented with. So you have certain companies in your portfolio, and then as companies reach out to you or a friend recommends a company, you look at that opportunity, and if that opportunity is better, when factoring in the tax ramifications of selling a particular stock, like in the States, if you sell it less than a year, you could be literally like 40% tax you could be facing if you're in the highest tax bracket. So you have to do all of that math calculation. If you sell it after a year, it's closer to about 20% tax. So I think you do have to factor that in when you're considering, do I sell now and move it into a different opportunity? But is the next opportunity better than the prospects that are still ahead of me in this stock? And that's basically how I look at it. And then in terms of the gold price, I'm also looking at how much of the gold bull macro move, hype, or marketing is already in this particular name before I buy it. Is it being valued with all of those added things external to the intrinsic value, speculative value of the junior mining stock itself?
Right. I remember I was watching a baseball game a couple weeks ago, the Blue Jays. I live near Toronto. And I saw a World Gold Council commercial, actually a very slick one. And I don't know, I think it's because I'm so used to so many years where gold has been ignored. And we did have the Idris Elba gold movie, whatever that was, 20 or 30 minute movie. I guess that was more than a year ago. So how do you gauge in terms of where we are in terms of the hype? Like I kind of look at Bitcoin as the interesting comparison, where the hype on Bitcoin, whether it was in hockey games, baseball games, football games, there was nothing you couldn't watch that I think, and I don't watch a lot of TV, but you were always seeing a Bitcoin ad. And seeing the World Gold Council with the Blue Jays game, I thought to myself, oh, maybe that hype, maybe it's just starting. But is that the kind of the hype or media? Is that what you try to look at too in terms of managing or looking at what the hype around the gold market is?
I look more towards the government stuff myself, and I might not be the best guy for this judge, but when I got into gold back in post Lehman Brothers, which then eventually led me into silver miners, which led me into these junior mining stocks, it was the expectation that the dollar was going down, that there would probably be a global reset. So that's the genesis of how I even got into junior mining stocks. So I focused more on that. And then, is this the time when the U.S. has to inflate away its debt? Is this the time when the dollar is dethroned? Like those big macro ideas that many people talk about and have talked about literally for 15 plus 17 years that I've been listening to people, those inform, I think, more of my expectations. So maybe I still hold a little bit of those expectations that those big macro events are going to occur. But at the same time, like when I think back of so many hours of macro commentary that I've listened to, Brian, that didn't come to pass within the time frame that they said would come to pass. Like I listened to so many Jim Willey interviews where he said the U.S. currency is going to split into two, and his sources tell him this and his sources tell him that, and so much of that, like 90% of it probably didn't even come true. So my conclusion was, I believe in the macro reason, the big picture reason why I need to own physical gold and silver. Therefore, I do, and I did before I got into junior mining stocks. And then everything I do on top of that with junior mining stocks is speculative. Someone asked me, what does your portfolio look like? I said, gold and silver in your own possession, physical assets, some real estate, my business, and then right to risky junior mining stocks. And that's how I do it.
Yeah, it's good. It's good. It's interesting going forward, like where we are in the cycle. It's just something that I've tried to think about more often. And I think, David definitely has been the person over the last, handful of years that has really put that to the forefront. And it's something that I find very interesting to hear him talk about. And I still sort of get confused about how the cycle actually works. I think you sort of touched on it in how you preface the question. If you go back to 2016, 2016 was the real turn of the market since the high in 2011. And then we went sideways for 3 years. And then we had a crash that was caused by something outside of the system, which if COVID didn't happen, for all intents and purposes, maybe we wouldn't even be where we are today. They could have kicked the can down the road. Whereas back in 2008, I thought with the amount of quantitative easing and low interest rates, that you would have to pay the piper much, much sooner than we have. So it's just interesting how these cycles work. And I think the more I look at it is the more I think it is unpredictable, and how I think that the past can be prologue, but it's so nuanced that I'm not sure that any of us, unless we're looking in the rearview mirror, can really understand where exactly we are. And I guess you just never know.
We had a question come in, Brian, about position sizing. You want to share any general thoughts about how you position size within your portfolio?
Yeah. Position sizing is actually probably one of the biggest things that has led to my success personally, over the last couple of years. What I think you need to do first, it's a self-realization type of thing of how you want to participate in the market. And the example that I've given is that you can take, like a 2% position and explore because it's high risk, take a 2% and, the upside potential might be a 10 bagger. So that might end up representing, let's say 20% of your portfolio. Or you can put 10% into a developer or something that has something tangible, something real, like a resource or an economic study, with the expectation that your position is going to double, which may or may not, depending on what your analysis says, may not be more probable. And you can still get that 20% allocation to your portfolio or upswing in terms of impact. And so what I'm trying to say is, depending on where you want to play, you can make your position size reflect that 10 bagger, but you're definitely going to have more confidence or conviction in it. And also, as always, you're going to have to be able to rely on your ability to pick these different companies. But I give that example so that you can see the difference, where you can allocate things from a 2% to a 10% and have the same result, and probably have a higher probability, and you're actually speculating in something that's real. So you need to understand where you want to put your money, whether it's in speculation, development, or production. There's a level of confidence that I think comes with each. There's a level of knowledge that comes with each. And once you find where you are on that spectrum and the amount of risk you want to take, then that can push you towards how you want to allocate. If you go back to my last conversation with Rick, and that's, I think, just over a month ago, I brought up position size with him. And of course, he wanted to talk about how it's all about the certain person. And I ended up reflecting it back on me so that I could get a more straight answer. But he's right. Like, it does come down to you and where you want to play. And that's the number one thing. The only other thing that he said there, I think that really.
But share what he said to you, though. I remember what he told you.
He said, he said that you don't want to, he's never had a position where he's seen the need or the risk profile to risk more than 10% in that position. which again, I think is pretty wise, because I think the temptation with conviction would be that I slant that 20 or 25% or maybe even higher and try to push, your chips all in that direction.
But he told you with your knowledge to go for it too, though, didn't he, Brian?
He did.
He told you to go for it and don't worry about volatility. Like, set aside what you need for your family. But with your knowledge at this point, he says, I think you can go for it.
Yeah. And because of what I've experienced, the highs and the lows, that I shouldn't be shaken out of a position. And again, like, that's a guy that's seen it all. I think, that is definitely impactful to me. But I think, that takeaway is right. Like, I truly believe that people should take calculated risk in their life, whether that's in the junior mining sector or that's, in your regular life, going out there, starting a business, or whatever that might be that's sort of maybe risky in your mind and that you're fearful of. But if you put your mind to it and you understand the risks, you should take it. So in consolidation is that you need to find who you are first. You need to see where you want to put your money, and that should reflect your position sizing. Obviously, if you're in the exploration side of things, I highly doubt you want to take a flyer and put 10% of your portfolio into one exploration stock, but that's up to you. Conversely, the developers and the producers, a little bit better risk profile. And that's maybe where you want to put more of your money if you're looking for that differential, that same impact, but less risk. But again, it's going to come down to you and your knowledge in the sector, and re-listen to that conversation with Rick, because, that's a guy that's been through it all. And always bestows so much wisdom in terms of that part of what being an investor or speculator is all about.
Brian, in our last show, I mentioned that there isn't a blacklist for bad CEOs in the junior mining space. I actually asked Dave Lotan about that as well. And so a question or a comment came in. How do you chart out what success looks like for each of these CEOs when you get a new name on your roster? So do you create a time graph of the decisions made by the CEOs? And if they make more good resulting decisions than bad, do they get a thumbs up from you? And to talk about this, I want to bring up a class action lawsuit that Ascot Resources is facing right now. This was in the news a month or so ago. And it begs the question, should and how management be held accountable for forward-looking statements that they make in order to raise money, but don't happen? And this is from an article talking about the lawsuit. The law firm stated about Ascot Resources that between January 22nd and September 5th, 2024, Ascot reported that after its February 22nd, 2024 offering of securities, that it would be fully funded to complete the construction of the Premier Gold Project, progress through the ramp-up phase to commercial production and steady-state operations. The company also reported that commercial production was anticipated to happen during the third quarter of 2024, and as a result, it would be self-funded for at least 12 months out. On September 6th, 2024, however, the company reversed course on its plans for the Premier Mine, reporting multiple operational issues and suspending all operations until additional capital was raised. Following these revelations, the price of Ascot securities suffered substantial declines on abnormally high volume. Ascot placed the project on care and maintenance in June after failing to reach a satisfactory cost agreement with its mining contractor. So, should management be held accountable? There's a class action lawsuit trying to hold management accountable for the forward-looking statements that they made when they were raising this money and laying out what they would do with it and what the money would accomplish, which that money did not accomplish what they said it would. Right.
So first, you can come at this from a couple different standpoints. I think that it's terrible, that the Ascot's position and what happened is terrible. It puts a blemish on the whole sector. But I think it's the reality of mining and what can happen. The guys behind Ascot had good reputations as, guys that should have be able to put this into production. I think it shows you not only the difficulty with starting a mine, but in this inflationary environment, kind of making sure that you have enough buffer that your CapEx budget doesn't get blown out, and it can quite easily. We've seen it with a number of companies. Nemaska is one of the ones that jumps out to me from, this would be about 6 years ago when they completely bombed on their construction go. But it's the reflection of how mining is. And I do not think that it warrants being sued. I don't see anything nefarious. I'm not that close to it. So I'm not sure if there was something nefarious that came out that, these guys purposely, made a mistake or did something. So to me, it's unwarranted to go out there and sue them. I think for all the stuff that happens in the junior sector, that sort of thing, unless it's very clear that management purposely did something wrong, that they should be sued. The guys that are out there really trying to rip people off, those are the people that I think you should be going after with class action suits, not the people that are actually trying to put things into production. And like I said, with these guys, from what I know anyways, to me, there was no sign of something nefarious going on. So, this is probably the reflection of somebody that unfortunately made a bad decision, or had not made a bad decision, didn't fully know the risks of what they were getting into, and now is trying to blame somebody else for the risk that they took, that they obviously didn't know that they were taking. And so that, I think that has to be, everybody has to understand when you're putting a development project into production, this is the risk. There's a certain percentage of them that just aren't going to work for a number of reasons. Nemaska, Rubicon, there's a whole host of failures out there. And that's just the reality of the mining business.
So you put the onus more on the investor than the management team than I thought you would. So like what I would ask is, okay, you brought the moral issue. Like, did they do this intentionally? Like, they knew they were lying to investors in order to just get the capital in the door. Okay. How would you prove that? I think that'd be pretty tough to prove. Like, each individual investor could come to their own conclusion about this management team, who I've never met nor talked to before, nor have I ever been an investor in this company. But then the second issue is, I would say, competency. If they raised money under these terms, and they told investors, this is what your money will accomplish, and this is the time frame in which your money given to us will accomplish this, and the exact opposite happens, do you question their competency even if you don't question their morality?
Sure. But I think that's the risk you take. I think, again, like I wasn't super close with this, but I'm pretty sure that the guy, the CEO, had a good reputation, or like a decent enough reputation. And so again, I don't see any nefarious act. I think this is something that was, again, you could maybe speak to the competency. Like Nemaska was a problem. They totally misjudged the CapEx needed to construct their project. This is in Quebec. And again, this is a lithium project. And I think it was around 2018, 2019 when it occurred, but it was on the CapEx side where they had completely misjudged how much money they need. They basically ran out and it just fell apart from there. And so, yeah, you could go back to competency. I think people make mistakes. And I think especially in the inflationary environment that we're in today, I think you're even that much more prone to, or you're more subject to the probability of making a mistake when it comes to, like, let's say this is a good example, Tocantinzinho with G Mining. G Mining builds open pit gold mines as their business. This is G Mining Ventures. And so when it parlayed into, or G Mining Services, and when it parlayed to G Mining Ventures, they had a specific plan that they knew they had to order the ball mills, a year out prior, and they raised money before they even did the initial construction package to order those ball mills, the anticipation of not only price escalation, but just getting the ball mills on time. It just showed the intricacy that they needed to make sure that they hit things on time and on budget. And I think you can still have good people. Let's say that, or go with the assumption that the guys for Ascot were good people and maybe don't have enough experience to go to that depth of planning. They have that much more or thinner thread to make a mistake. And again, I would lean towards that in terms of this, because again, I know people that invested in Ascot, they were more upset about the deal, that when Ascot bought, I forget they bought Red Mountain. I forget what the company was even called, but I heard more people were upset about that deal, and they were more upset about that deal, but the management team that sold Red Mountain, than anything associated with Ascot. And so, and like, for that reason, like, you go back to that Red Mountain deal, it's like many people that I know were upset about it because they said that it wasn't a deal that was in shareholders' best interest. And to me, like, if you're going to get upset, that's more along the lines of where you want to get upset. You know, these execution things, yeah, okay, you can make the argument that there's something wrong with the competence of the person executing. But I think even good people can come up short when it comes to construction of a mining operation and operation of a mine. And so, you know, my leniency towards who I place the blame on is much wider. And I still go back to the investor. And this even comes with, you know, the mistakes I've made with investing in the wrong people. Even though these people are nefarious and their intention is to rip me off, I still put it on myself because, especially at this point in my career as an investor speculator, I should know better. And I should be able to pick out, I think, those points that should lean me towards, you know, this guy probably doesn't have the best intentions, or his experience maybe doesn't lend itself towards what he wants to do. And so again, like I would put in this case, I would say it's more on the investor's standpoint, and I would look to more the moral stance of management to place blame on them and where the guy should be facing lawsuits.
Have you ever seen a lawsuit against management, that class action lawsuit in the junior mining sector that was victorious?
Well, that's a good question.
My point is this. I don't think there's a lot of recourse or consequences for management. So I without going into details, like the morality of management, the competency of management, the delusionality of management, and whether they believe their own lies when they say, Bill, if you give me money, and I have written checks, you give me money, this is what your money will accomplish, this is what we have going on, to where later on when things didn't work out and I dug into it, I said, this guy was completely delusional. Like, is he a liar? He believes his own lies. Like, he didn't even have a business plan that would accomplish what he told me he was skilled to do and was going to do, and just needed a little bit of capital to accomplish that. So how do you discern delusionality in a CEO? And I mean that seriously. I'm not being a humorist here. They say it with confidence, but Brian, they're delusional. They can't accomplish that.
Yeah, no, I get it. I think, man, it's a really good question. And it's definitely something that I've tried to ask myself. And I'm not sure formulaically you can actually say that, you know, just look for this, and this, and then you'll know. I think with enough experience, you know, most of us can look at a deal from the outset, maybe the cap structure, who's involved in the management team or directors, or who you might know is involved as a large shareholder, tells you a lot. Like, there's certain people I just will not even acknowledge. And I even regret taking a meeting because I knew somebody was a director on the company. Is like, I don't want any part of this person. And so I think, you know, with enough time and effort, you know, and observation, you can just learn people to steer away from. In terms of new people, you know, it's more difficult. You know, I would say that mentors have taught me, and I've seen it myself, that you can probably look at the balance sheet and see where they're spending their money in terms of salaries, in terms of marketing, more or less where the money is being funneled. And especially if that marketing budget is bigger than the actual spend on the property, that's a pretty telltale sign that, you know, these guys are into mining the market and not as much putting value into the ground or extracting value from the ground. And there's more segments that come to that as you dig deeper. And to me, it's also, and I sort of hate to say, but it's also a feeling you get from some people. Like, for me personally, I like to talk as much as I can with the CEO or whoever it is I'm talking with the company. And I think you get a general feel about what these guys are all about, how they want to frame different questions or frame different answers to your questions, how they want to talk about exploration and development, you know, where that path goes as they raise money, their ability to raise money outside of maybe necessarily their group. And this is something we talked about before, where, you know, success in the business can come through luck. And you can use that money to sort of prop up other companies that are made there to milk the market.
And the reputation you gain through the luck.
Yeah, exactly. So you just have to, I think you have to sort of see that and see the people that, and it goes back to those people that are involved and where they're getting their money from. Like, are they attracting some of those bigger funds, not the really ambiguous ones, but some of the bigger funds, the bigger names. And usually that is, again, another way to discern. And especially, let's say, one step removed from us, let's say the general retail investor, you're going to have to be even more discerning at those kind of higher steps, because you don't know the people and their networks as well as we do. And I'm not sure how you necessarily get past that without being more involved in the sector, going to all the conferences and just being around long enough. But again, you can use the balance sheet. You sort of talk to the guys, see what their plan is, what they're headed for. Like, is this one of those stories that just has been around for 10 years and they just keep on recycling it in each bull cycle? And you can just see that the share price just goes up in the bull and then just comes flooding back down. Those are sort of, again, more telltale signs. And there's a number of junior companies out there that seemingly are just able to reboot their same story, cycle after cycle. And again, so as a general retail investor, those are the sort of things I would probably look for first. And then again, going back to Rick would tell you that, especially if you don't have a lot of time, just stay at the very, very top of things, investing in the Ross Beatties, investing in the Robert Friedlands, like these sorts of names, that you want to stick to, that sort of weed out, that that are there to ultimately make a mining operation or find something of value. Whereas the other guys, it's definitely more of a question mark.
So you mentioned stories that go around and around. One such story is Ascot Resources in Ecuador, the searching for the lost cities, kind of that narrative. And unfortunate, the government was going to charge them a fee equivalent to $24 million administrative fee, and which was greater than their market cap. This was maybe a month and a half ago this came out. So charge them an administrative fee of $24 million just to do exploration, which doesn't make money, as we all know. So they functionally, you put the company out of business, or at least out of Ecuador. So there are things that happen to where you can't run a exploration company anymore when the government does this, which begs the question, which is what Ed Baer said on my show, early June, I believe it was, when he said Ross Beatty sold Lumina Gold for less than what he thought it was worth because Ecuador was turning over for the negative. This sure seems to be a sign that Ecuador is becoming less friendly to Explorcos. What do you think?
It's interesting. And so first I'll say, I still believe that it's a mix of why Ross sold Lumina. Mm-hmm. I think it may be because of what we're seeing here is like a degradation of the Ecuadorian mining investment climate. But it's also because of maybe the quality of the deposit. So I think it's still both of those things. In this case, I don't know where they get that number from. I did a little more research on this when I first heard about it. And there is this sort of land fee or land carrying fee that they're coming out with. Or they call it an administration fee, whatever you want to call it. And there isn't a direct line in the stuff that I read anyways that says that if you it's this cost per hectare. It seemed to when I researched it, there was a whole bunch of different companies that sort of reported this tax and it was all over the place in terms of what the cost per hectare or cost per acre. And so I don't know how they came to such a big number for our area. That seems like very unreasonable. So in this, this could be the picture of Ecuador on its decline. And if you look at these things move in cycles, what surprises me is that they have somewhat of a pro-business or a conservative leaning government in place, and this is sort of coming from them. And maybe it's sort of a glimpse at what it takes in some of these countries in South America to sort of maintain power. And maybe that's what this is like go looking to the next election. We're going to satisfy maybe the more left-leaning part of the country with this sort of tax that extracts more money from these junior mining companies and producers to suffice the demand from the people. Maybe that's what it is. But all I'll say is I don't fully understand it. And it doesn't seem to be straightforward with how they come up with these numbers from what I can tell. All I can say is that we sold in the newsletter, we sold our only exposure to Ecuador much earlier this year. And now I have no exposure. And so I haven't taken that more of a glimpse at to what's actually going on. But it wouldn't surprise me if we were on a downslope. That's usually how these things go after sort of attracting, the BHPs of the world a few years ago for Soul Gold and those sorts of projects.
The Beaver Creek Precious Metals Summit is next week. Do you have any meetings scheduled with any Ecuadorian companies? I don't.
No, I don't think so. And I actually went a little bit lighter on my one-on-one meetings with the hopes of spending more time, just talking to people, not in the formal way, but the informal way, which has usually led me, more value, than the one-on-ones. But Beaver Creek is sort of that like pinnacle of precious metals conference that I personally go to. It's my favorite. So I'm very much looking forward to it.
Any further thoughts or things you want to chat about, Brian?
No, I think that's good.
All right. Well, we appreciate your listenership. Another episode of Junior Mining Insights with myself and Brian. We appreciate your listenership. If you haven't already, please hit that subscribe button, and we'll catch you on the next one.